Okay, let's unpack this. Greenwave Technology Solutions, ticker GWAV.
Right.
This company, a metal recycler, its stock price has it's fallen off a cliff, down over 99% in the past year.
99%. It's almost unbelievable.
It really is. So the big question is, what on earth happened? How does a company fall that far that fast? And maybe, is there anything left? Any hidden value? Any chance of a turnaround?
It's a dramatic situation, absolutely. And it's exactly the kind of thing that makes you stop and think, especially if you're interested in value investing or just the risks involved with companies in, well, deep distress.
Exactly. So for this deep dive, we've gone through a stack of information on GWAV, specifically looking at where things stood on April 18th, 2025.
When the share price was languishing at just 16 cents.
16 cents. And our sources include some pretty deep research analysis trying to make sense of it all.
And for you, our listener, the learner, this isn't just about GWAV's specific story.
No, it's a chance to look at value investing principles in action, maybe. See the dangers when a company gets into this kind of trouble. Is it a learning opportunity or just a big red warning sign?
That's what we're here to figure out. Our mission today is really to dissect GWAV. We'll look at the business itself, how it's supposed to make money.
Then the leadership, right? Who's in charge?
Definitely. Then the financials, are they solvent? Making money?
Spoiler,
Probably not.
we'll get to that. Then market sentiment, who actually owns the stock, and a full risk assessment.
The goal is to see if there are any insights for you, or if this is purely a cautionary tale.
And we'll definitely touch on those U.S. tariffs everyone's talking about and this idea of a moat the company sort of claims to have.
Okay, sounds like a solid plan. We've broken it down into 7 chapters to keep things clear. First, understanding the business. Second, evaluating management.
Third, the all-important financial health check.
Then in the second half, we'll cover market sentiment, ownership structure, and that risk assessment, a SWOT analysis. And finally, we'll wrap up with a conclusion and a final thought for you to chew on.
All right, let's jump into Chapter 1, Business Understanding. What does Greenwave actually do?
Okay, so at its core, GWAV is a metal recycler. They've got 13 facilities, mostly in Virginia and North Carolina, plus some in Ohio.
And they do what? Collect old cars and washing machines?
Pretty much. They collect, process GART, which means sorting it, shredding it, cleaning it up, and then they sell scrap metal, both ferrous, iron and steel,
Right.
and non-ferrous, like aluminum, copper. They sell this processed scrap to big industrial companies.
Who uses it as raw material?
Exactly. The research names some big customers, like Nucor, Sims Metal, Cleveland Cliffs,
Yeah.
even Georgia Pacific.
Okay, so they're taking junk metal and turning it back into something useful for these big industrial players. Where's the money come from?
Well, the main revenue stream is just selling that processed scrap. Simple enough. But there's a strategic shift happening, or so they say. They're pushing hard towards domestic sales. They're projecting like 75% of their sales in fiscal 2025 will be right here in the U.S.
That sounds like a big jump. Why the change?
It seems mostly driven by those anticipated U.S. tariffs on imported steel and aluminum. The idea is if imports get more expensive, domestic scrap becomes more attractive.
Makes sense. Are they doing anything else besides just scrap?
They're trying. They've got this thing called the Scrap app. Uses AI, apparently, to help source junk cars more easily.
Ah, interesting.
And they're dipping their toes into recovering rare earth metals, which could be valuable. Plus some government contracts, like one with Virginia Beach.
But are these things actually making money yet?
Doesn't look like it, not significantly anyway. The research suggests the Scrap app and rare earths are pretty limited financially so far. The main game is still processing and selling basic scrap.
Got it. Now, they call themselves a leading supplier sometimes. Does that hold up, given their situation?
Yeah, that's a good point. Leading might be a bit of a stretch. As of April 2025, their market cap was tiny, around $10 million.
10 million. That's microcap territory.
Exactly. Their customers, like Nucor, they're multi-billion-dollar giants. Same for many competitors. So GWAV is a very small fish in a big pond.
But they mention their locations, right, near the Navy base.
They do. They highlight facilities near Naval Station Norfolk and the Port of Virginia, suggesting maybe they get unique access to military or port scrap. So perhaps some strategic value there, locally.
Okay, maybe a niche player then. What's their main pitch, their value proposition?
It seems to be focused on providing 100% domestically sourced recycled metals, tapping into those potential tariff benefits and the whole sustainability buy local trend.
And the scrap app efficiency thing.
Right, and maybe leveraging those locations near military bases talking about supporting critical industries, national defense, that kind of thing.
So fundamentally, how does a company like this actually turn a profit? What's the basic mechanic?
It really boils down to the spread, the difference between what they pay to get the scrap and process it and what they can sell it for.
Buy low, sell high, basically.
Pretty much. And their efforts, like this scrap app or rare earths, are attempts to widen that spread, either lower costs or sell for higher prices.
But the proof isn't really there yet financially.
Not from what we've seen in the numbers, no. The core business, that basic scrap spread, is still what drives everything, or fails to drive profit, as we'll see.
Okay, business model understood, more or less. Let's move to Chapter 2, management. Who's running this ship?
The chairman and CEO is Danny Meeks. He's got a background in this industry, hauling, recycling. Founded a few companies before.
Oh, really?
Yeah, Meeks Disposal, Select Recycling Waste Services. Apparently sold them.
Wow.
He also founded Empire Services, which is basically the core of GWAV's operations now.
So he built up the main part of the current company?
He's that way. Grew to 11 locations before it became part of this public entity. He even did some time on the Portsmouth City Council. So experience in the sector, definitely.
Okay, sounds relevant. But what's happened since GWAV became GWAV? After the name change from Mass Roots back in 2021, how's the performance been under his leadership?
Well, that's where the picture gets pretty grim. We already mentioned the stock price down over 99% in the year, up to April 2025.
Just brutal.
Brutal, consistent, substantial financial losses, repeated warnings from NASDAQ about being delisted because the share price is so low.
Delisting threats. That's serious.
Very serious. And lots of turnover.
Mm-hmm.
CFO changes, board director changes. Plus, they scheduled a special shareholder meeting for January 2025.
Yeah.
And then canceled it just days before with no explanation given.
Oof. Not a great look for transparency.
Not at all. It doesn't exactly build confidence.
So facing all this trouble, the losses, the delisting risk, what have they actually done about it?
They've been doing a lot of financial maneuvering, mostly. Big debt-to-equity conversions, basically turning debt into shares.
Including debt held by the CEO himself.
Apparently so, yes.
Yeah.
And they've been raising money through selling new shares, registered direct offerings, private placements.
Which dilutes existing shareholders, right?
Heavily. Every time they issue new shares, your piece of the pie gets smaller. They also bought the real estate for some facilities, trying to cut down on rent costs.
Okay.
And they've talked publicly about doing a reverse stock split.
To artificially boost the share price back over the NASDAQ minimum?
That's the usual reason, yeah. A move often seen as a sign of desperation.
So lots of financial engineering. What about communication? Are they upfront with shareholders?
They put out press releases quite often, and those tend to focus on the positives, potential tariff benefits, new contracts, revenue projections, the scrap app.
The optimistic stuff.
Exactly. Their website paints a positive picture, too. But then you have that canceled shareholder meeting hanging out there completely unexplained. That really undermines the transparency claim.
Right. Any bright spots?
Well, it was reported the CEO waived his quarterly bonuses for fiscal year 2023. So maybe a small gesture there.
Okay. Any other ethical concerns? Scandals? Reputation issues?
Nothing majorly scandalous jumped out from the research.
Yeah.
But you have this constant stream of upbeat promotional communication.
Well, the company is losing tons of money and the stock is collapsing.
Precisely. That disconnect makes you question how objective their statements really are.
Yeah.
We also saw some insider selling by a director in early 2025, which contrasts with some insider buying late in 2024.
Mixed signals from insiders then.
Yeah. And there's just this nagging contrast between Meeks' reported success building Empire privately and the struggles GWAV has faced since going public under his leadership.
It's a fair point. So wrapping up management, the key questions. Are they honest, capable, shareholder-oriented? What's the verdict?
It's really tough and honestly quite concerning. Honesty. The promotional tone against the bleak results raises flags about full transparency.
Right.
Capability. Past private success, yes. But translating that to the public markets with GWAV, the results speak for themselves and not positively.
And shareholder-oriented. That's the big one.
Well, you could argue restructuring debt avoids worse outcomes, and there was some insider buying. But that's massively outweighed by the value destruction, the dilution.
The potential reverse split.
Exactly. And the CEO's debt converting into preferred shares, which often have advantages over common stock. It doesn't scream common shareholder first.
So overall, a very mixed, mostly worrying picture on the management front.
I'd say that's a fair assessment based on the data.
Okay, let's pivot to Chapter 3, financial health, the numbers. This is crucial. Give us the snapshot as of April 18th, 2025.
Right, and getting a perfectly clear snapshot is tricky. We found some discrepancies in key metrics across different data sources. Things seem to be changing fast with all the restructuring.
Okay, so with that caveat, what do we know?
We know the share price, 0.16 cents, market cap around $10 million. Trailing 12-month revenue was about $33.9 million.
Okay, generating some sales. But profit?
No, trailing 12-month net income, a loss of roughly $86.2 million.
Wow, losing way more than their revenue.
Significantly more. That translates to a big loss per share, though the exact number varies. Net profit margin, deeply negative, around minus 28%, maybe more, depending on the source.
Minus 28%.
Yeah. And returns on equity, return on assets, also negative. They're not making money off shareholder investments or their assets.
What about the balance sheet? Debt, cash.
The debt-to-equity ratio looks much better in recent data, maybe around 0.17. That reflects those debt-for-equity swaps.
So less debt on paper.
Right. And cash was reported around $10 million back in February 2025, though that figure has bounced around too.
So the big picture from the snapshot is
Yeah.
sales, but massive, massive losses.
That's the unavoidable takeaway. Generating revenue, yes.
No.
Turning any of it into profit, absolutely not. It's a huge red flag.
And those losses are just staggering. Negative gross margins, negative operating margins, negative net margins. How do they even keep the lights on?
Through financing, essentially, which we'll get to. But it's a deep hole.
How does this reality square with their optimistic revenue guidance? They projected like $50 million for 2025, right?
It's a major disconnect. Even if they hit that higher revenue target, the fundamental problem remains. They haven't shown they can be profitable at any recent revenue level.
So more sales doesn't necessarily mean profit for them.
Not based on their track record, no. They need a fundamental shift in their cost structure or pricing power, not just more volume through the unprofitable machine.
What about cash flow? Are operations generating cash?
Nope. Trailing 12-month operating cash flow was negative $17.25 million.
Burning through cash, just running the business.
Exactly. And overall, cash flow, including investing and financing, has generally been negative too. They are consistently reliant on external funding, selling more stock, issuing warrants just to keep going.
That sounds precarious.
It is. It means they're constantly needing to tap the capital markets.
So back to the balance sheet. We mentioned the debt conversions improved the ratios. What was the cost to shareholders?
A very significant cost. Dilution. While the debt load might look lighter, it was essentially paid for by giving away more pieces of the company.
So existing shareholders own less of a potentially healthier but still deeply unprofitable company.
Precisely. For you, the listener, this is critical. Debt reduction isn't always good news if it comes at the expense of massive dilution.
Good point. So stepping back, assessing overall financial stability, key takeaways.
Okay. Earnings, wildly inconsistent, consistently negative. Dividends, none, and no hope for any soon. Debt management, done via dilution, not profits.
And short-term health, liquidity.
The ratios, like quick ratio and current ratio, might look okay on the surface, maybe 1.36 and 1.52 respectively in some reports.
But that's misleading.
It could be. It likely just reflects the cash they recently raised by selling stock. The underlying cash burn is the real issue. How long does that cash last?
So you need to look past the ratios sometime.
Absolutely. Understand where the cash is coming from and where it's going.
So let's hit those key questions directly. Is the company profitable with a strong balance sheet?
No. Categorically no. Deeply unprofitable, and the balance sheet improvement came via dilution, not operational strength.
Are earnings volatile? Do they have excessive debt?
Earnings are extremely volatile, consistently negative. And while debt levels are lower now, they got there by diluting shareholders, indicating past financial fragility and arguably excessive debt previously.
Okay. A very clear and frankly worrying financial picture. We need to take a short break, but when we come back, we'll dive into the second half. Market sentiment, ownership, and the crucial risk assessment. Stay with us.
Welcome back to the Deep Dive. We're digging into Greenwave Technology Solutions, ticker GWAV. Before the break, we cover the business, management, and the, frankly, dire financial situation.
Dire is a fair word, yes.
Now let's move to Chapter 4, Market Sentiment. How does the market feel about GWAV? What's the general perception?
Well, the market feeling seems pretty clear. Overwhelmingly negative.
You don't say after a 99% stock drop.
Exactly. That price collapse down to around 16 cents is the loudest signal. It's hitting all-time lows. The trading is also super volatile.
There's even chatter comparing it to a meme stock, suggesting maybe Retail speculation on social media is a bigger driver than fundamentals.
Interesting. Any specific groups?
We saw some reports mentioning negative sentiment among investors in India, specifically. But overall, the negativity is broad-based. It shows a profound lack of market confidence.
Okay, so definitely not popular. What about Wall Street analysts? Are the professionals covering it? Giving price targets?
That's another telling sign. Almost complete radio silence from Wall Street.
Really? No coverage?
Pretty much zero.
Mm.
Major data providers show no current one-year price targets from established analysts. We found one source mentioning 2 analysts, but no estimates used. Another said 0 coverage.
But wasn't there one outlier?
Yes. We saw one single data point somewhere claiming a strong buy with a $2.40 target.
$2.40 when it's trading at 16 cents.
Precisely. Given the total lack of any other coverage in that huge gap, that data point looks highly questionable, probably old or just unreliable. The lack of coverage itself is significant.
What does that usually mean?
It often means the company's too small, too risky, or just not seen as a credible investment opportunity by the professional analyst community. For you, the listener, that absence can be a warning sign.
Makes sense. Now, we talked about how the company puts out positive press releases.
Right, quite actively.
How does that square with this negative market view? There seems to be a disconnect.
A massive disconnect. The company talks up tariffs, revenue guidance, contracts, debt restructuring, the scrap app, rare earths, all positive spin.
But the market sees.
The market seems focused on the NASDAQ non-compliance warnings, the dilutive stock offerings, that unexplained canceled shareholder meeting, the negative realities.
So the company narrative isn't landing.
It appears the market is weighing the negatives much more heavily than the company's positive projections. That divergence is really important for investors to note.
Okay. What about short sellers? People betting against the stock.
There's definitely notable short interest. Reports range from maybe 4% up to 9% of the float being sold short.
Is that high?
It's significant. The days to cover ratio is low, like 1 day, meaning lots of trading volume relative to the shorts. And off-exchange short volume is often over 50%.
Meaning a lot of shorting happens away from the main exchanges.
Correct. But maybe the most telling indicator is the short borrow fee.
How much does it cost to borrow shares to short?
It was running around 20–25% back in April 2025. That's quite high.
And high fees mean?
High demand to short this stock. It suggests strong conviction among some investors that the price is going to fall further. Options data was a bit limited in our review, though.
So overall market sentiment, negative, skeptical, with active bets against the company.
That sums it up pretty well, yes.
All right, let's move to Chapter 5, ownership structure. Who actually owns GWAV? Let's start with the big institutions.
Institutional ownership is incredibly low, like barely there, consistently reported between 0.5% and maybe 1.3%.
That's tiny. Who are the holders?
Names like GWAV Capital, Anson Funds, though they seem to have cut their stake, State Street, to Sigma. But the key point is, many institutions have sold out completely or reduced their positions drastically.
So the smart money isn't interested or got out.
It strongly suggests a lack of confidence from large, sophisticated investors. For you, the listener, very low institutional ownership is often seen as a red flag.
Okay. What about insiders? Management, the board, how much do they own?
This gets a bit fuzzy. The reported numbers for insider ownership vary wildly.
How wildly?
We saw figures from around 9% up to well over 500%.
500%? How is that even possible?
It probably isn't for common stock anyway. That high number likely includes preferred shares, maybe convertible debt, or could just be calculation errors in the data feeds.
So hard to get a precise figure. Who's the main insider?
CEO Danny Meeks is consistently named as the largest individual holder.
And we saw some buying and selling.
Right. A cluster of insider buying in late 2024 Meeks and a couple of directors. But then one director sold some shares in February 2025. So mixed signals again.
Given the low institutional ownership and the unclear but potentially high insider stake, what does that mean for ownership concentration?
It suggests that if those higher insider figures are somewhat accurate, even including preferreds, there's significant concentration, mostly with the CEO.
And since institutions own so little?
It strongly implies that most of the freely traded stock, the float, is held by retail investors, individuals like you and me.
What are the implications of that structure for corporate governance?
Several things. First, that NASDAQ noncompliance and delisting risk is a huge governance issue hanging over everyone.
Right.
Second, the canceled meeting raises transparency questions. Third, the board and exec changes suggest instability.
And the CEO's potential control.
If he holds a large chunk, especially with preferred shares, he could have substantial influence over decisions, which might not always align perfectly with common shareholders, especially minority ones.
So governance concerns stemming from the ownership structure and the company's situation.
Definitely factors to consider seriously.
Okay, Chapter 6, Risk Assessment. Let's use the SWOT framework. Strengths, weaknesses, opportunities, threats. Start with the strengths. What's good about GWAV?
Okay, strengths. They have an operational footprint. 13 facilities in 3 states. That's tangible.
Physical assets.
Right. Some locations are strategically useful, near military bases and ports. They claim some grandfathered licenses might act as local barriers to entry.
Okay.
Their focus on 100% domestic supply could be a strength given tariffs and sustainability trends. They have established customers, including big names. And those government contracts offer some base business.
So operational presence, strategic locations, domestic focus, customer base. Got it. Now, the weaknesses. This list might be longer.
Yes. It's pretty substantial. First and foremost, severe financial distress, unprofitable, burning cash, poor returns.
The stock performance itself.
Catastrophic performance, extreme volatility. They lack scale compared to competitors, putting them at a likely cost disadvantage.
The dilution.
Massive shareholder dilution from raising capital. Their new growth ideas, scrap app, rare earths are unproven financially.
And management credibility.
Concerns there, given the disconnect between the positive talk and the negative results we discussed. These are serious internal hurdles.
Agreed. What about opportunities, external factors that could help them?
Well, the overall recycling industry has positive long-term trends. Environmental awareness helps.
The tariffs.
The 2025 U.S. tariffs could boost demand and prices for their domestic scrap. That's a big potential if.
Any others?
Nucor opening a big new mill nearby in North Carolina could increase regional demand. Their tech, like the scrap app, might improve efficiency. Rare earths could be a higher value market.
And maybe getting bought out?
Theoretically, yes, though their financials probably make them a less attractive target right now or would mean a low price.
Okay, some potential upsides. Finally, threats. What external dangers are lurking?
Intense competition from larger players. They're hugely exposed to volatile, scrap metal commodity prices.
That NASDAQ delisting threat is #1, right?
Absolutely huge.
Yeah.
Major execution risk. Can they actually pull off a turnaround? Can the new initiatives work?
Financing risk.
Constant threat of needing more cash, leading to more dilution, uncertainty around those tariffs, what if they change or backfire?
Regulations, economy.
Regulatory changes in recycling, definitely. And a broader economic downturn would hurt demand for scrap. It's a challenging environment.
It really sounds like a battle between those potential opportunities like tariffs and the immediate threats, like delisting.
Exactly. And you get the sense management is focusing so much on the opportunities because the threats are so urgent. They need a win fast.
But the SWOT analysis suggests their internal weaknesses really limit their ability to grab those opportunities or fight off the threats.
That's the conclusion, yes. From a value investing perspective, the internal weaknesses significantly outweigh the external opportunities, making it look very high risk as of April 2025.
All right, that brings us to Chapter 7, Conclusion. Let's try to summarize this deep dive. What's the final takeaway on Greenwave?
Okay, summing up, GWAV is in a growing industry, metal recycling, but the company itself, it's facing severe financial headwinds, profitability issues, management effectiveness questions, and significant risks.
Their turnaround hopes seem pinned on outside factors and unproven ideas.
Largely, yes. Things like tariffs playing out favorably and new ventures like the scrap app or rare earths suddenly becoming major profit drivers, which hasn't happened yet.
So from a value investing lens, as of April 18th, 2025,
it just doesn't tick the boxes. No consistent profit, no clear sustainable advantage, and certainly no obvious margin of safety in the valuation given the risks.
Okay, so here's a final thought to leave with you, our listener. We've seen how much GWAV seems to be banking on those U.S. tariffs.
Right, it's central to their optimistic narrative.
So what happens if those policies shift, or if some other global event throws the scrap market into chaos? Could GWAV in its current fragile state actually survive without that potential tariff boost?
And that leads to a broader question this whole GWAV situation brings up for any investor, really.
Which is?
How much weight do you give potential future catalysts, things that might happen, versus a company's current fundamental weaknesses and its actual track record?
Is it smarter to bet on a struggling company turning around because of external factors it can't control?
Or should you focus on businesses that are already profitable, have stronger foundations, and have proven they can handle challenges? It's a core investing dilemma.
A really vital question to ponder, especially when looking at turnaround stories. If you found this deep dive helpful and want more analysis like this, definitely subscribe to the Stock Analytics AI YouTube channel.
All the links to the research and sources we used are in the description below.
And just a reminder, this analysis reflects information available as of April 18th, 2025. It is absolutely not financial advice.
Please always do your own thorough research before making any investment decisions. This is purely for informational and educational purposes, based on public data and AI analysis.